Hey friends, welcome back to the channel. My name is Sanj and today we're going to talk about two types of ETFs that I generally don't like to invest in. Now this is obviously a personal preference and I'm just sharing it with you. It's not financial advice, but I just thought if you're similar to me in terms of some of my characteristics, and I'll go through them soon, these are maybe ETFs that are possibly not in your wheelhouse of things to consider. I'm not sure if I messed up my analogies, but you get my idea. So on the Australian Stock Exchange, there's about 200 odd ETFs. I think it might be 250, but about 200 odd ETFs. And they're broadly categorized into this list of categories that you can look at here. Now within them, there's two types of ETFs that I would generally avoid. And to go into that detail, let me first start by describing the kind of person I am in terms of what I look for. So I'm very much a long-term investor. I'm very much a buy and hold investor. And I'm incredibly lazy. Back in the day, maybe when I was younger, I was all about looking for the hustle, looking for the ideal opportunity, the thing that will get me the maximum returns and all of that. Now I'm a lot more casual. Now I'm sort of happy with 6, 7, 8% returns, maybe even 5% returns. I'm just looking to take up a position in an ETF, hold it for a while, let it grow for a very long period of time. That's sort of my strategy. I'm not looking for like 40, 50% returns overnight. I'm not looking to try and beat the market. I'm very happy with achieving the market rate because the market rate is not bad at all. So in terms of my target portfolio, I generally try and aim for 75 to 90% in targeted ETFs and listed investment companies, and the rest of the portfolio really goes towards individual companies that I might see an opportunity with. But even that's starting to drop away. I'm becoming incredibly lazy and I just want ETFs really. But that's where I'm at. So the first category is the hedge negative correlated ETF category. And I'll use the example of BetaShares Bear. I've got nothing wrong with BetaShares and the Bear. I'm just using this as an example. BetaShares Australian Equities Bear Hedge Fund. Let's have a look at what they describe it as. A simple way to profit from or protect against a falling Australian share market. Bear is designed to go up when the market goes down and vice versa, in brackets. So it's a great sounding ETF, but my concern with it is it's not really something that you can buy and hold over a long period of time because it's really there to take advantage of dips in the market. So let me throw up some graphs to help you visualize this. Here's an example of the COVID era, should we say, the March 2020 period. Dark blue line is Bear, light blue line is A200. So they're both BetaShares products. One is the long position, should we say, where it buys ETF, buys holdings, the normal ETF buys holdings of the A200 companies and holds it over time. Whereas the Bear is like the inverse, where it's trying to take advantage of the market going down. And you can see when the COVID events started to occur in late Feb, early March, Bear starts to go up while A200 starts to go down. So if you had both, you would have sort of gone sideways, should we say, because one would have gone up, the other one would have gone down. Now the thing about Bear though is it's sort of a trading, I call them trading ETFs, I don't know what the technical term is. The idea with Bear is you should really be buying it when you think the market is going to go down, hold it, and then when you think the downwardness of the market has finished, sell it and get out of it. Not financial advice, but I think that's how it's designed to be done. Because it's not something you're meant to hold on to for a long time, because look at this is a trend of Bear over 2 years. This is now a trend of Bear over 5 years. Okay, look at that. It's just constantly going down. This is not something you're meant to buy and hold. It's obviously something you buy when you have those spike events, but that's the challenge, is you need to know when that spike event is occurring. Maybe you miss the first couple of days, but then you buy it and you hang on to it and then get out when you think the spike event has stopped occurring. So this is why, for me, because of long-term hold, very lazy, this kind of ETF is a bit of a struggle for me to look into. Now there are similar types of ETFs and I'll list them on screen, but these are ETFs that I would generally avoid. They sound great on paper and I don't think there's anything wrong with them intrinsically. I think the idea is if you're a long-term investor, this is something that you really need to trade in and out with. And I don't know if people have like the time or the patience to sort of do that. And also, when was the last time you predicted when the share market was going to go down to the point that you could take advantage of it over a long period? Like, when's the next COVID going to happen? So, especially looking at this long-term trend, like if you forget about it in your portfolio, which I'm sure you won't, but if you forget about it, you'll lose a lot of money along the way. So the next type of ETF is the very narrow industry-specific ETFs that I sort of avoid. Now, again, I don't have anything dramatically against these. It's just my investment style does not align to these ETFs, or the other way around. So examples of these ETFs that I would be avoiding are the ones that are targeting like cloud computing, environmental technology, robotics, artificial intelligence. These types of very niche industries I generally avoid. Now, I understand why someone might want to target specific industries because, theoretically and on paper it sounds great, but I think it goes a bit away from the whole idea of ETFs, which is meant to be very broad categories where you're capturing market returns for that market, that geographic area. I think that's the idea behind them. But I understand nowadays we're getting very narrow indices or indexes being created, and the ETFs will naturally be created for them. Because for an ETF company, for them to make money, they need a lot of products and a lot of money in each of those products. So I understand why the products are coming out. I just don't know if they're great options for people who want to do very long-term, broad type investing. And that's someone like me. So that's why I would avoid it. But I also understand the idea behind it. Like, for example, I'll do a video in the future about this, but at one point I was very keen on the lithium market. And I invested in it directly through an individual company. And I have a friend who did exactly the same thing, but he got 4 companies because he didn't want to pick a winner. He just wanted to get exposure to the lithium market. Now, in that kind of situation, I can understand. But we both knew these were temporary transactions. But if you're more of a long-term person and you don't want to get too involved with your portfolio, these are probably not great because they theoretically sound great, but you're not sure if that industry is necessarily going to keep going up or it might go sideways for a bit. The other thing I would call out, and this is probably the key thing, is if you're going to go for one of these ETFs, is check the underlying holdings. Because a lot of the time, these underlying holdings may just be in the NASDAQ. Because a lot of advanced technology companies, advanced companies in general, are probably going to be listed in the US on the NASDAQ. So why wouldn't you just get something like NDQ, which captures most of the companies on the NASDAQ anyway? That's just a thought, Rook, that's just a thought, but that's why I sort of look at these industry-specific ETFs and I say, I understand why BetaShares created it, because it's a great additional product that they can add to their suite. I understand why the index company created the index, why wouldn't you? But I don't know if these are the great options for everyday Australians who just want to get, generic exposure to the share market for a long-term buy and hold strategy. The other concern I have is if this ETF doesn't necessarily gain momentum in terms of funds under management, funds flowing in, at some point the ETF might lose favor in BetaShares portfolio and they'll shut it down, which could trigger a bit of an unfavorable tax event. So something to consider. So that's why I would say if you're looking for ETFs to invest in over the long term, these bear hedge type ETFs and these very narrow industry specific ETFs are probably ones to avoid. You stick to sort of the broader category ones where you're looking at top 200, top 300 companies or MSCI type indexes where they're going global kind of footprints. That's just some thoughts that I wanted to share. Hopefully that was a quick, short and sweet video. If you're interested in any of my other videos on ETFs, check them out here. Check out my newsletter and I'll see you in the next one. Bye for now.